Welcome to The Explainer. Today, we're jumping into a really wild world. A world where things like rare watches, fine art, and vintage cars aren't just hobbies anymore. Nope, they're being treated like serious financial instruments. Audited, locked in vaults, and sliced up for big money portfolios. But are they really the new IT asset? Let's dig in and find out.
So let's kick things off with this whopper of a statement. This is the big promise, right? The central idea we're going to tear apart today. The idea that your luxury watch is some kind of magic bullet, a stable, high-yield investment that's completely safe from the roller coaster of the stock market. Is that really the case, or is something else going on here? To get to the truth, we're going to take this step by step. First, we'll talk about the allure of these tangible assets. Why are they so hot right now? Then, we'll look at the tech that's turning them into tradable crypto assets. After that, we hit the big question. Is this a real investment or just pure speculation? We'll also uncover the hidden risks and costs that nobody likes to talk about. We'll bust the great correlation myth, and finally, we'll give you a much smarter way to redefine what an asset truly is.
Okay, first up, the allure of tangible assets. Before we can even talk about the money, we have to understand the psychology. What is driving this massive cultural shift that's pushing these luxury goods into the spotlight?
Well, the whole point of luxury has changed. It's not about quiet, personal enjoyment anymore. In the age of Instagram, these things are for peacocking, for showing the world you've made it. Influencer culture has just thrown gasoline on that fire, and a growing global customer base has sent demand through the roof. And the brands? Oh, they've gotten really good at playing the scarcity game, with things like limited drops that create an absolute frenzy and drive prices sky high on the secondary market. It's this powerful cycle that makes it feel like these things can only go up.
So you've got this red-hot market for physical stuff. And of course, the tech world comes knocking. They saw a huge opportunity. What if we could make these clunky, hard-to-sell items as easy to trade as a share of stock? And this, my friends, is where things get really ambitious and a little bit wild.
The magic word here is tokenization. Now, don't let the jargon scare you. A token is basically just a digital pink slip. It's a secure, unforgeable record on a public ledger, a blockchain, that proves you own something, or even just a tiny piece of it. That digital proof is what makes all of this possible.
Okay, so how does this actually work? Let's take a super rare watch. First, it gets checked out by experts to prove it's real, then locked away in a super secure vault. Then, a unique digital token, an NFT, is created that represents ownership of that specific watch. But here's the cool part. That token can be digitally sliced up into, say, 1,000 little pieces. This lets 1,000 different people own a tiny share of a multi-million-dollar watch. All of a sudden, this totally illiquid thing is now liquid and tradable. Of course, you can imagine this is giving regulators a massive headache.
This all sounds incredible, right? Making luxury ownership available to everyone. But hang on, this is where we have to hit the brakes and ask the most important question of this entire explainer. Are we actually investing here, or are we just gambling? What's the real difference?
Okay, this is the absolute key. An investment is something that is designed to put money into your pocket. Think of a rental property that pays you rent every month, or a stock that pays you a dividend. It generates cash. Speculation, on the other hand, produces nothing. Its entire value is based on what's called the greater fool theory. Your only hope of making money is to find someone else, a greater fool, who is willing to pay more for it than you did.
And our source material puts it perfectly with this quote. I mean, think about it. A painting on a wall, a rare Pokemon card in a safe, a bottle of wine in your cellar, none of them are paying you rent or dividends. The only way you get cash out of them is if you sell. It's basically a game of hot potato. And you're just hoping the price goes up before you have to sell it to the next person.
Now, let's say you're okay with that. You're fine with speculating. Well, the game is still rigged against you from the start. There are some very real and often ignored costs and risks that are constantly eating away at your potential profits. It's like trying to run uphill from the get-go.
Let's start with a number. -2.5%. What in the world is that? Well, that's the price of admission to this game, before you even place your first bet.
That right there is the financial drag. See, unlike a stock, a physical thing has to be stored, secured, and insured, and those costs never stop. It's just like your home insurance. You pay it every year whether your house burns down or not. This means your prize collection has to go up in value by more than 2.5% every single year just for you to break even.
And then there's the boogeyman in the closet, counterfeits. The sources use a perfect analogy here. A certificate of ownership is like a valet ticket. It proves you have a real car in the garage. But what happens if someone can print off thousands of perfect fake tickets? They're worthless. With superclone watches out there that can fool even the experts, you face the very real terrifying risk that your six-figure asset is actually a fake, instantly wiping out 100% of its value.
Okay, let's talk about the big sales pitch. The one you always hear, that these assets are a safe haven, that they have zero connection to what the stock market is doing. But is that really true when the chips are down?
Here's the brutal truth. The data shows that while these things might not move with the market during good times, that all changes when a real crisis hits. Just look at the 2008 financial crisis. The market for stuff like fine art and classic cars got hammered. The idea that these things exist on some magical, protected island, it's pretty much a myth. And here's why. When real financial panic hits, people don't sell their stocks to go buy a painting. They sell everything they can to get their hands on cash. Because in a crisis, cash is king. The buyers for illiquid, non-essential luxury items, they just vanish. And suddenly, the price of everything starts falling together.
So, if collectibles aren't this magical, safe investment, what's the right way to think about them? If a Rolex isn't an investment, then what is it? Well, this brings us to a much more powerful and frankly smarter way of looking at wealth.
This whole idea, made famous by the book Rich Dad, Poor Dad, is a total game changer. It defines an asset in the simplest, most powerful way. An asset puts money in your pocket, period. Think of it like this. Every dollar you put into your asset column is like a tiny employee that works for you 24/7 to make you more money. Anything that takes money out of your pocket is a liability. It's that simple.
And this quote just hits the nail on the head. It reframes the entire discussion. The goal isn't to buy luxuries to look rich. The goal is to build an asset column, a money machine, that's so productive it can buy those luxuries for you, using the income it generates.
So here's the playbook. It's a sequence. You don't start with the fancy watch, no. You start by building your asset column first, your portfolio of cash-producing machines. Then you let that cash flow grow. And only then, as the very last step, you use the profits, the income from that machine, to buy the luxury item. The asset buys the luxury, not you.
This is the new perspective. In this model, the luxury item isn't a financial tool. It's the ultimate reward. It's a trophy. It's proof that you have successfully mastered the game of building real cash-flowing assets. It is a symbol of your financial intelligence, not a replacement for it.
And that really brings us to our final thought. After looking at all of this is the question you should be asking yourself. It's a shift from chasing shiny objects to focusing on building a durable, productive financial engine that works for you. Thanks for joining us on The Explainer.